Hey everyone, it's Jeff Harrelson with Grizzly Loans, and today I just want to go over what is a residential loan. A loan provided by a bank or financial institution to individuals or families to purchase residential property such as a house, condo, even a manufactured house. The borrower pledges that property as collateral for the loan, meaning if they fail to repay the loan, the lender can seize the property through a foreclosure process. Most residential mortgages either have a fixed adjustable rate loan throughout the term of the loan, fluctuate after the initial fixed period based on the market conditions. A fixed rate will remain the exact same rate throughout the term of the loan. The typical loan term is usually 15 to 30 years, but you can make it whatever you want. You can make it 28 years, you can make it 12 years and 3 months if you really wanted to. And there's also ways to manipulate it by having a 30 year, but pay it off like a 15 year. So it gives you the flexibility with your payments that you can pay it like a 15 year, but if you ever need to go back, you can go back to a 30 year payment. It's one of my favorite things to advise my clients, unless there's a big spread between the 15 and 30 year fixed rate. There are also some loans that can go up to 40 years. These are generally non-qualified mortgages, so usually they do have higher rates, but will make your payment slightly less because it's spread out over 40 years. Residential mortgages often require a down payment. Now there are some programs like USDA that you could do with zero down, and there's zero down programs that are tied to loans, whether it's conventional or FHA, that allow you to get in the house with nothing down. But the majority of loans will have some sort of down payment. 3.5% for a regular FHA, 3 to 5% on conventional minimum, and jumbo loans usually minimum is 10%. The larger the down payment, usually the better terms you're going to get on that loan. With doing this, you kind of have to weigh the options. If you're putting 10% down on $1 million loan, it's $100,000. But if you put 20%, it's $200,000. If the difference in payment is say $700 a month or $800 a month, it might make sense to put less down, because while it's a higher payment, you'll have an extra $100,000 sitting in the reserves that you can access at any time. You can also use that to start paying it down faster too. Many residential loans also have extra costs that people don't think of. There's things like property tax that you have to pay. It can be added into the loan payment, or it can be paid separate depending on the loan. Then you have insurance. Especially right now in a lot of states, it's hard to get insurance, and insurance costs are rising. So always double check right away when you're looking what insurance costs can be. You might also have an HOA due. And the other thing is, if you put less than 20% down, you may have private mortgage insurance. All these can affect the total payment that you're going to be making for the home you're looking to buy. So I just want to break down a couple things on residential mortgages to give you guys a better idea, because not everyone knows what exactly it is. Jeff Harrelson, Grizzly Loans. Call me for more advice.